Okay. Burner Trading Group. This is I Can't Wait For It. And today we're going over volume accumulation, accumulation distribution. These indicators you can pick up at Thinkorswim for free. And if you don't use Thinkorswim, you can get Thinkorswim for free and download the indicators and use it for charting because you're going to want to, especially after this video. And so let's go ahead and get right into it. The first thing you want to do is you're going to find your last previous higher high and draw a trend line going across. So that way you can see where price action is going and where it's having problems. The next thing you want to do is look down here and you see this green line spiking up and down. That is the volume accumulation line. And then the accumulation distribution is just the volume chart that you see that goes with it. Now, how do I use this? Well, what you do is you scroll over and you see these M's. Everyone always uses the M as a signal, like, oh, once it does this M, it drops. Yeah, I mean that's pretty much it, And you know the W, and you see that big W right there, and they're like, whenever you see that W at the bottom, it means it's going up, and it does. And so what that means, sum it up, and I'm not going to go into too much depth, but the M is distribution. What is distribution? Distribution is when you flood the market with supply, with all the shares basically that you've gathered up. And so let's say I'm some company, let's say I'm XYZ company and I like to buy up all the AMD shares. And so I'm talking about like 90% of them. And so I carry around 90% of all the AMD shares until they're not making me any money anymore. And then I just dump them into the market. And when I dump them in the market, it sends the price action cascading down because there's so many shares. And so, how the market works is you've got supply and you got demand. Well, there is no demand if you have a surplus of supply. So when I flood the market with 100 million shares, well, guess what happens to the price? It drops because there is no demand for it anymore because there's that influx of supply. And so when price comes cascading down, it gets to a certain point where XYZ company looks at him like, "Oh my God, why did I let go of it? It looks so good now. It didn't look good when I had it in my hand up here, but now it looks a lot better once it's way down here. I have to have it." And they gobble up all them shares. And look at that candle. Oh my gosh. That is not a normal candle. When you look at all the other candles around it, that is a very abnormal candle. And that's called an institutional candle. And that's them buying up all the shares that they just dropped. Right here, boom, they just dropped all those shares and buying them all up. And not only are they buying up all the shares that they just dropped, but you got all the bears jumping in as well, plus all the FOMO of all the people that were trying to go up, jumping back in to go down. And, that set this cascading down. And so they're being shaken out of their contracts, of their shares, because as it's dropping, it gets to a certain point, XYZ companies buying them back up and driving the price up past all these people's stop losses that you just jumped in on, shaking them out of their contracts, freeing up those contracts, putting them back into float. And then because they're just floating out there in space, it's dropping the price again. And then that's them buying it back up. And so that maneuver is what causes this W. And once they've soaked up 90% of those shares, the last little bit is left out there for the retailers. That's me and you. And so then once they've soaked up all those shares, and then us retailers, millions and millions of retailers are fighting over just a handful of shares that are left over, well, guess what happens? The price goes up dramatically, and then you got FOMO jump in as well, and then, it just spikes up. And that's what creates this W. So you associate the W with absorption. And absorption is what I just said right there, where it just buys up all the contracts and there's basically they've soaked up all the float and there's just a handful left. And then retail fights over that handful left and drives the price up. And so then XYZ company gets to ride that price action for free going up. After they just bought all those shares down here, they ride it up here until it starts to run out of steam. And then once it runs out of steam, they dump all their shares back into the market. And that's what causes the price to cascade down. So that is a quick crash course on absorption and distribution. And remember I said in the last Bollinger Band episode that if you saw full bandwidth consolidation, that meant the price was about to drop. Well, there you go. That's what that is. And all that is a mix of distribution, accumulation, distribution, reaccumulation, and redistribution. and and that's what makes up that. So when you see that shape of full bandwidth consolidation, it's moving across both sides of the mean and eating up the full bandwidth of the Bollinger Bands back and forth. That's what that means. That's what's going on right there. Is that the price action? They're getting ready to distribute a big mother load out, and once they get to that point, it's going to dump. And so when you see these spikes going up, that means they hit absorption. But when you see the spike go up again, or volume go up again before price goes up again, then it's going to come down. And so what you want is you want the spike to go up and volume to diminish as price goes up. And so you ride for free. And so whenever you see volume spike up like this, after a spike like this, that's bad because a lot of people, you always hear people say like, oh, there's not enough volume pushing this price up. You don't want volume pushing the price up because if you had volume pushing the price up, not only do you have a lot of buys come in, you got a lot of sales coming in too. And if you got a lot of sales coming in, guess what? You are saturating the market with extra contracts, which means there's a lot of liquidity down below. And if there's liquidity down below, XYZ company can't stand it. They can't contain themselves. They don't want the shares in their hands anymore. They want the ones down there because they're better. So they let go of the ones in their hands, they cast them off the hill, and then they run tumbling down the hill to get to the bottom to pick up the shiny ones at the bottom, and then pick up all the ones that are running down the hill behind them, back up, so that they can ride all those shares back up to the new promised land, to the new highs. And so that is the rotation of accumulation and distribution. So couple extra things to think about when it spikes down to the bottom here on accumulation, volume accumulation, that green line right there hits zero. That means that they pretty much dumped most of their shares out and they're reaccumulating at this point. Boom, dumped. It bounces twice and pretty much gotten rid of every single bit of their shares. Boom, and now it's ready to go back up. If it spikes to the top twice, it's the same thing. Then it's ready to come back down. Usually have about 3 bounces after it spikes in any one direction before it goes in the other direction. So if it spikes down, you got 3 bounces before it goes up. If it spikes up, you got 3 bounces before it comes down. And it can be bouncing downward, it can be bouncing upward, it could just be bouncing sideways. You have to get really creative in how you read the bouncing. But once you've done it a couple times, you'll know what it looks like. But that's all I got for you today. Hopefully that was helpful. Hopefully you learned something. Um, I'll get more into all this accumulation and distribution a little bit more in detail as you learn more about some of these indicators and everything like that. I'm just going to kind of ease you into it, but I appreciate you for showing up and watching. And if you got any questions, write them in the comments below. I'll be glad to answer them. And I'll see you on the next one.